In this session we're going to look at the fixed assets and depreciation work paper. And this is normally work paper J in our workbook. Now this is where things can get a little bit confusing and you're going to need to go backwards and forwards between the ledger and our work paper, and in many cases even look at prior year work papers. Okay, now you'll notice here in the ledger that we have some items listed as fixed assets. Oops, not that much. These numbers here. In this case, the ledger only has one classification of fixed assets. It is usual for us to have motor vehicles, plant and equipment, buildings, land if necessary, furniture and fittings, to have multiple classes of assets listed in the balance sheet. What we need to be able to do, like with any other balance, is we need to be able to provide a schedule that agrees the totals of our final balance sheet with a work paper that supports all those numbers. What we'll notice here is that depreciation hasn't changed this year to last year, which means that we haven't calculated depreciation and posted a journal. So there's a flag that says that we've got some work to do in terms of posting a journal for depreciation. The other thing you'll notice is that our fixed assets cost value has gone up from 2519 to 3640. What that means is they have purchased about $1,200 worth of new assets this year, so we want to make sure that we are looking for that in the ledger and adding them to our fixed asset schedule. The first place we're always going to start when it comes to our fixed asset schedule is to get our opening balances in correctly. Now you'll notice in some cases we are using the fixed assets register in 0, in which case we would skip this page completely. In fact, we just make a note right here that says see 0 report, and maybe sort of give that J2 and probably just leave it like that. You might even want to highlight that so it's obvious that that is what we're actually doing. Okay, so for example we might do that and leave the rest of the page blank. By the way, there is absolutely no point in retyping something that has already been prepared. So if we have a debtors report from an accounting system, it's adequate for us to simply reference the total of that report rather than retyping it. We don't need everything retyped into the spreadsheet. Likewise, if there is an assets register already created and maintained by the client, we usually maintain it, but if they already have it, or if it's a separate spreadsheet, it's completely okay to leave it as a separate spreadsheet. You don't have to bring it in and put it into this format. So long as it's giving the right information, we can leave it as it is. What we can see here from last year's work paper is that they had a single asset called a personal computer, and what we're going to do is make sure that we've copied this information into the correct section of this work paper. And I know that this client, we did not set up the 0 ledger until 1st of April 2012, so this information is not in 0. Okay, the purchase date here, we'll just copy across if we have it. Opening cost value 2519.48. Opening accumulated depreciation, which will be this number here. And this spreadsheet opening book value is for 1.87. This spreadsheet is actually designed to automatically calculate depreciation for us based on the depreciation rate we've chosen, how many months to depreciate, which is 12 for a full year, and the opening balances that we've already put into the system. Okay, so right now what we've done is we've now created, in this case it was very easy because it was just one item, our opening balance. Just again a note here, as I said, we don't need to retype anything that already exists. In some cases, if we had this information and it was a multi-line asset register from the prior year, it might be sufficient to simply delete these rows and copy and paste these rows in from the previous worksheet. Or if it's a complicated one, split it out to a separate file and just save it as J2 or J1 in this case, and simply roll it forward. When you roll forward a fixed assets register, you generally want to start by copying your closing balances and pasting with values into your opening balances. And so you'll start with rolling backwards or rolling forwards your closing depreciation and making that opening depreciation, your closing cost price, making that your opening cost price. If you had additions during that previous year, you would make sure that new addition became the cost price, and months to depreciate would become 12 for anything that was on hand for the whole year. Now in this particular situation, we haven't yet calculated depreciation, but we also know that the client had new assets they purchased during the year. So we are going to go to Find Transactions. I'm going to look up the account called Fixed Assets, make sure our date range is set for 1st of April 11, and here we can see they actually purchased something. Now we don't know what this is. Oh, here we go, iPad 2. So they purchased an iPad for $1,289 including GST. And you can see that after GST, because we always record our assets excluding GST, it was $1120.87. So we're going to put this down in here as an addition, $1120.87. And we're going to say iPad 2. And the purchase date was 28th of December 2011. The depreciation rate will be the same as for computers, 60%. And months to depreciate, we include the month of purchase, so in this case it's going to be 4 months. The system should now automatically calculate the rest of my values. There's no accumulated depreciation because it wasn't on hold, wasn't held at the start of the year. So now we actually should have our depreciation for the full year, and we should be able to reconcile this back to the balance sheet. We have said that our cost price is now 3640.35. Let's see if that agrees. 3640.35, exactly. So now we have our fixed assets cost price reconciled to our balance sheet. Our opening accumulated depreciation was 2277.61. That's unchanged from the previous year. Our final step now is to journal our depreciation. Before we do that, we'll just check the rest of our schedule and make sure we've done everything we need to do. First task here is review the fixed assets ledger accounts and verify that all items should be capitalized. In this case, they bought an iPad. It's a valid asset, so we can say yes, we reviewed everything they've added to their ledger and we verified it can be capitalized. Just make that a bit smaller. Now, the next thing we might want to look at is repairs and maintenance expenses, and other office expenses or computer expenses, and to see if there's anything that they have expensed that maybe should be capitalized. Now, the rule in New Zealand is that items over $500 can be must be capitalized. So in this case, we're looking for computer expenses, and we're looking for anything over $500. And if it comes on the same date, you might want to double check because they might have split it out into multiple lines. Anything purchased from the same date, from the same supplier, for the same type of equipment would need to be capitalized. So for example, if they bought a table and 4 chairs, even though the table might be worth $300 and each chair worth $100, the total of those transactions is $700, and therefore it would need to be capitalized. If the whole purchase together was $499, after GST, it would not need to be capitalized. Again, any questions, feel free to ask. Repairs and maintenance is another great example where things often get coded as repairs when they are actually new assets. In this case, they haven't got a repairs code, so that's a good start. Let's just quickly look through to see if there's anything else that might be hiding large expenses. General expenses is a common one, but there's only one there. Another good way to find missing assets is to just do a quick report on your balance sheet, on your profit and loss. If we run this down here and particularly look at your expense codes, items purchased for sale don't count, but that's all I think they're right off of the stock mostly. So here we're just going through here to look. Anything that's less than $500 automatically means it can't be in it. So fuel, we're not worried about that. Telephone, no, that's probably not hiding fixed assets. Could be hiding a purchase of a new cell phone, but only $600 for the whole year. Then that's probably just regular usage. And vehicle expenses, nope, that's not going to be hiding any fixed assets at that value either. So in this case, I think it's safe for us to say that we have checked and there are no other fixed assets that we haven't included. Okay, we have rolled forward our register from the prior year, and we have reviewed our register for disposals. One of the things that often happens is they might buy a new computer or a new vacuum cleaner, and as an example, that might replace an old asset. So if we see that happening, we might want to actually write off the old asset because it's no longer productive. And the IRD rules are that when you replace, if you get rid of an asset or it ceases to be productive, you can actually write it off. If that happens, please contact me for more information, because they do require a little bit of just extra processing. So in this case, we now have our fixed assets register balanced and up to date, with the exception of posting depreciation. We normally process depreciation by asset class. So we'll go back to our MYOB here, close out some of these windows, and we'll record a journal entry. In this case, we only have one asset class, and the depreciation expense is called depreciation. The amount is 369.29, and it's going to go to fixed assets. Accumulated depreciation on fixed assets. So the debit is going to depreciation, and the credit is going to accumulated depreciation, fixed assets. No GST on any of these. Make sure it balances, and click record. Now, if I was to go and look at a report for my balance sheet, we'll see that fixed assets 3640.35 with accumulated depreciation of 2646.9. There is 2646.9 accumulated depreciation, and our closing cost of 3640.35. So now we know that we have balanced our work paper back to our assets, back to our ledger. Now this was a very simple example. On some clients there might be a couple of dozen items, and so it can get a little bit complicated. Always look for ways to simplify what you're doing rather than simply retyping something for the sake of retyping it. Again, if you have any questions, give me a call.